Okay, guys, let's do a quick payrolls briefing then. Got my usual screenshot here, looking around the asset classes. I mean, probably the big market to take note of ahead of payrolls is this one on the bottom left, where, of course, we had a powerful breakout to the upside, the back of some very weak ISM non-manufacturing data, dollar weakness, dovish Dudley taking us up through, well, firstly, the January top at 110, and then we took out the December top at 110.88, and of course, big extension in the last couple of days, huge move here for the dollar. Really one of the very weakest couple of days for the dollar for years. All right, so this is the big move. I think probably the dollar is going to be perhaps therefore most influenced off this data. Of course, if it is better than expected and we get a reversal of some of this dollar weakness. But look, let's do things in order here. Let's have a look. We're going to hit at the same time. We've got payrolls forecast 190. We'll have a look at the chart in a minute. But of course, last month was huge, 292. Last quarter, in fact, quarter four of 2015 was massive for this. I'll show you the chart in a second. So that'll be the headline, obviously. We get the unemployment rate as expected to stay and remain unchanged. It's been at 5% for a few months, not expected to budge off that. The average daily earnings is then also really important. We're expecting a drop on an annualized basis, 2.5% wage growth. In December, we're expecting that to drop to 2.2% wage growth. This is important for the Fed's inflation outlook and therefore timing of any Fed rate hike number 2. So this is the shape of the data. Let's have a look at what happened last time. Here's a chart of payrolls, as you can see. And as I said, last month was massive, 292, and last quarter was huge, a really powerful end to 2015. This is why the Fed hiked. You can see the labour market momentum very strong here. But the key thing we want to find out today, was this seasonal? Is this telling us a lie? What is the momentum trajectory for US GDP? Have we, the GDP data itself showed a pretty large drop in growth in quarter four, and this is why this job creation data seems a bit odd. It seems a little bit out of line with that. Is it seasonal? A lot of the big banks are talking about the fact that December, we had really warm weather, and did this contribute to more jobs being created? For example, the construction industry added 45,000 jobs in December, a month where we normally see job losses in that sector. So what's going to happen in January? Are we going to see a lot of these jobs that were created in December, are they kind of stolen from January, if you like? Are we going to see a drop off? We're expecting a drop to 190. There's concerns it's going to be a big drop. Banks like Goldman think 170, Bank of America think 170, Deutsche around the same, but kind of rumoring of 150. I like what Bank of America was saying. They think that the exceptionally favorable weather in December provided a boost to the data. They reckon their models suggest that there'll be some payback in the following month, that's January. But importantly, they reckon there's going to be an even larger payback in 2 months' time. They're saying the February data will be even worse than January. So they're expecting a drop to 170 for January. They then expect a further drop from there in February. And if you get a couple of months in a row of back-to-back weak numbers, then forget your rate hike. The Fed will certainly take note of that. And given other economic data pointing towards a slowing momentum, like that ISM non-manufacturing figure we had on Wednesday, and that's definitely enough ammunition for the doves on that FOMC to steer the Fed away from the rate hiking cycle. So, yeah, a little bit of nervousness. That's the kind of mindset going into this data. Let's just quickly look at the unemployment rate chart. Here it is. We've been at 5% for 3 months. We expect to stay there. There is a chance we might dip below 5%, but you know what? It's not really important. We're back to pre-crisis levels. So the unemployment rate here isn't really going to have an influence. I would say most important number, of course, is non-farm payrolls. Don't forget revisions the previous months as well. And then I'd say the next most important will be the wage growth data. So here's the chart. We had disappointment here. This was the contradiction in December's report. We've got a really strong job creation number, but a real disappointment on wage growth because it hit zero again. Now we're expecting, if I go back to the calendar, you can see the average hourly earnings on a month-on-month basis is expected to be plus 0.3%. Annualized, it's expected to be at 2.2. Okay, so this wage growth number is important for inflation expectations. Check out the current probabilities according to the Fed funds futures. There's a 90% chance of no hike in March. There's an 88% chance of no hike in April's meeting. There, and you can see all the way down, even in September, 67% chance of no hike. We're basically now pricing in zero hikes for 2016, which is pretty extraordinary because you've got to go back literally sort of 7-8 weeks, and the Fed told us we'd have four hikes. So, dramatic alteration in the expectations the markets are pricing, and that's why you've got dollar weakness, of course. We just switch to the chart here. The charts, big dollar weakness move over the last couple of days, triggered by that ISM number. So if we think about the employment data we've already had, it's actually a little bit of a mixed picture because the ISM numbers, that's manufacturing and non-manufacturing, both show very weak employment components. This is a concern. But when you look at the ADP report we had on Wednesday, here's the chart. Well, all right, big drop from December's very strong reading, but we still say above 200,000. So, it could have been worse with the kind of reaction, even though on this chart it looks like a massive drop, but really that December number looks a bit of an anomaly. So that's the warm weather perhaps playing a role. So I think you're probably going to get a similar pattern for payrolls. Let's just go back to the payrolls chart. You're probably going to see a big drop. It's just how big. We're expecting it below 200,000, but how much below 200,000? And don't forget, the worse this number is, don't forget we're expecting even worse for February because the snowstorms hit in January. The snowstorms are not expected to have too much of a negative effect on January's numbers, but it's expected to have a large impact on February. So it's going to be, if this is bad today, we're going to expect even worse for February. Okay, so bear that in mind. Right, how is the market going to behave here? Obviously, 200,000 is important. I know we're expecting 190, but really that 200,000 level is key. Anything above 200,000, there'll be a bit of a relief, a sigh of relief that job creation has stayed resilient. You'll get some dollar strength because we've had so much dollar weakness. I think on that euro-dollar chart, check out the top from December, 110.88 would definitely be a key target. You've got at least 100 pips to get back down there. That would be a key support level, dollar strength off a number above 200,000. Of course, anything that's 225 and upwards, 250 and upwards, well, you're going to get a big move on the dollar. We're going to have to, again, dramatically change our rate hike expectations, and you're going to see the dollar probably break back below December's high and probably retest the 110 handle. Okay, so look for dollar strength or strong numbers. Can the dollar weaken if the data's bad? And the answer is definitely yes. I mean, I know we've weakened to the tune of, well, basically 300 pips here in the last 2 days, but it definitely can go further. There's no reason why we can't drive up, break the 113 handle, test the 114. You can see here that the big level for euro dollar on the upside is now the 115 handle. It's really the top of the range for the last 12 months. I don't think we can get to 115. It's probably a stretch too far given the move we've already had over the last few days. But 114 might be a target if you get a number sub 150, for example. Quickly then on equities, how is the S&P going to react? We've had a wild week. I mean, it really has been just extraordinary. Just check out my bottom right-hand chart. Oil, this has been dragging equities around quite sharply. Another pretty phenomenal day yesterday for oil. Big move higher, followed by a bigger reversal. We're on the up, and we've just hit resistance at the pivot. For equities, I don't know, it's a difficult one. I think at the moment we don't expect any hikes anytime soon. So maybe the monetary policy angle is not really a feature, or not as big a feature for the equity market. I think we're just straight out concerned about growth. So I think you may well get a conventional response. Look what happened to equities when the non-manufacturing ISM data came in really bad. You got just a straightforward risk off, a sell-off in equities. Forget about this, the idea that, well, that means we're not going to get any rate hikes. That's got to be good news, isn't it? I mean, that argument's kind of gone. So I think you just get downside for equities off bad news, upside off good news. We're right in the middle. You got a pretty good range from yesterday's session. Kind of in the middle of that now. We can certainly get to either side. 1890 on the downside key, 1922 on the upside. Okay, you can certainly get to either side of that range, depending on the numbers, of course. All right, so I'm going to keep it short and sweet. I'm going to leave it at that for now. Data is coming at 1:30 as usual. Don't forget, you're going to get a lot of numbers at once. We can get some violent response. There's going to be a lack of liquidity as orders dry up and orders get pulled off the ladders. So, never forget to tread carefully. There's nothing wrong with just sitting back and letting the initial carnage play out before, making a more considered decision and getting involved. All right. So, good luck.